Welcome to Retire Smart, the Uninitiated Guide. I'm Tennille Alonzo, your host, and I would like to say your resident retire ready strategist. If you agree with me, you can put a thumbs up in the chat. But I am here to support those of you who are really interested in preparing for retirement, this glorious time that we have to look forward to. And preparing for retirement should not be seen as a chore. It should be seen as a joyful exercise. I mean, how could you be, in any way feeling down about looking forward to creating a life that you design and not something that is based on your normal day-to-day routine, going to the quote unquote job or plantation, as some would like to say, where you design exactly how you want to spend the rest of your time here on earth. So it's a joyful experience that we'll be planning for, but we must start. We can't wait until we are retired to be planning for retirement. And so if you're tuning in for the first time, I want to say a big welcome. And if you're returning because you really love this content, I really appreciate you. And I thank you for subscribing in advance. I thank you for liking this video and for sharing it because it's really important that we get this message out. Now, if you've been looking at the news recently, you would see that the conversation around retirement is shifting a whole lot. We see, for example, that governments are increasing the eligible ages for Social Security access. When, we're seeing, for example, in the United States, they want to increase the eligible age for accessing Social Security from 67 to 69. And we're seeing similar conversations all around Europe and even here in the Caribbean. We're also seeing the impact of inflation and other economic headwinds on current retirees, where income seems to not be sufficient to deal with the lifestyle needs of current retirees. And it does beg the question, if current retirees are experiencing this, how would that in fact impact us as we get older? And these are things that we have to prepare for and to grapple with in our planning. And then, of course, I'm also seeing on the field that many young professionals are just coasting toward this future. There's this level of apathy around the future. And so planning for the future is not something that most young professionals are really doing well. And so this is really why we have programs like this. We have this podcast. We also have a course that I designed recently to really help persons understand the importance and to also have that clear roadmap of how to do it. But before we dive into today's exciting episode, and I can tell you it's a really good episode to really tune into, I want to honor someone incredibly dear to me. And that's my grandmother, Ellen Charles, who just celebrated her 100th birthday. Yes, she is so beautiful. And you can see in her smile here, glowing. She doesn't look a day over 60. But she is an example of grit and wisdom and love and giving. She's a wonderful human being. And I believe God gave her that grace to see this wonderful milestone. And she's certainly living proof of a well-protected life that can blossom into a multi-generational legacy. And so when we talk about today's episode, which is about protecting your future, your income, and the people you love, I really want us to reflect on my grandmother and the fact that she is a representation of a long retirement and the importance for us to also consider that we too may live as long as she. And because of that, we want to plan and to prepare. But what it also shows us is that retirement it could be a whole new volume of life, because she lived 40 years, 40 to 35 to 40 years, because I believe she retired at 65. She lived 35 years in retirement. That's an entire generation. When she retired, there were no smartphones. Internet was just about coming up, and certainly no AI. Just the change that she would have witnessed in that generation. You can also have a similar experience. And of course, I am hopeful that we can all enjoy a long life as she and do so because we have actually prepared for retirement. So, if you're new here, this show is really where busy professionals get the straight talk roadmap to retiring confidently and intelligently. And that is so very critical as we go into this new period of reality as we see all around us. But today, we're zooming in on a piece of that plan that too many of us treat like a side dish, and that's insurance. Yeah, I see it all the time. And most times I talk to persons, they think that retirement planning is only about savings and investments. I get it all the time, but we know it's not. Okay. Because insurance is a very critical part of being retire ready. Now, stay with me because by the end of this episode, you'll know exactly how high net worth families use insurance to create wealth, while the average person leaves money on the table. And we want to change that. Okay, so let's jump in. Now, most of what we think we know about insurance typically comes from either glossy ads or hallway chatter. And we don't want all of our knowledge to be based on what we see or hear from others in a random situation. So, in this segment, I want to really just bring it to a level of reality and show you how the other side looks at insurance, but also to bust a few myths in the process. All right. So the first myth I want to really look at is this one that says insurance is just for death. Well, in fact, that is not the truth, right? Because the right policy can actually fund things like college, it can buy time during illness, and it can keep your business afloat. Of course, you would need an advisor to help you structure it accordingly. But another myth I see is if I can self insure, I can and I should. I don't need to get a policy from an insurance company because I have enough money in the bank. Well, let me tell you, right? The wealthy who could pay cash for everything, they don't. In fact, they rather let the insurer's money do the heavy lifting while their own capital keeps compounding. And if they're doing that, why should you do any differently? Okay. A third myth is that insurance is a sunk cost. And that's not the truth because if it's done properly, a policy can become an appreciating asset that grows tax advantaged in terms of, you being able to access that money tax free. So now that we have looked at that, I want you to see some important statistics. According to the Global Wealth Insights report in 2024, roughly 71% of ultra high net worth families, when I say ultra high, I'm talking about persons who have a net worth of over 30 million US. They owned permanent life insurance as a cornerstone of their estate plan compared to just 48% of upper middle income households. Why does this matter? Because when almost three quarters of the wealthiest households made permanent insurance non negotiables, only fewer than half of rising professionals follow suit. And it therefore exposes this glaring protection gap. Those who can least afford a costly misstep are often the most vulnerable. And I see it every single day. So now that we've shattered some myths, let's look behind the veil a bit and talk about some of the six things that generational wealth creators do that typically we don't, and how we can potentially adopt every single one of those plays. The first is the wealthy use life insurance to create cash value vaults. And by that, what I mean is that they use life insurance products such as whole or universal life to build liquid reserves that they can borrow against for things like emergencies or for deals. So, in other words, while they are protected against the risk of death, they also capitalize on the value of time to build cash needed as life needs mount up. So, if you're thinking about retirement needs here, ding, 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 that is also one way to create a cash reserve in retirement should you have an emergency or a specific need. Secondly, they create what we call creditor protected cash parks. Yeah. And by that, they shift a slice of their liquid savings into things like permanent life insurance. So under our law here in Trinidad and Tobago, the policies, cash values, and payouts are generally shielded from most creditors, which of course gives you an extra layer of asset protection while your money keeps growing. So, for example, if you've set aside $500,000 in a business account, by redirecting that amount or some of that into a whole life policy, these funds or those funds, in fact, become lawsuit resistant, but they still are accessible through policy loans if an opportunity or an emergency arises. So it does help you to create a creditor protected cash park. Thirdly, they use it for legacy on autopilot because policies pass privately outside of probate, which delivers liquidity to your estate in weeks, not 6 to 18 months that it will take for a will to be probated, for example. So, just to give you a little more clarity, when someone passes away, right, the bank often freezes their accounts. Property sales are stalled until the estate clears probate. And in so doing, that leaves families scrambling to cover things like funeral costs, mortgage payments, school fees, business payroll from their own pockets. Or worse, they are forced to sell assets at a discount. But what happens is a life insurance payout could bypass all of that and lands in your beneficiary's hands within days, giving them calm cash to keep living and moving and settling urgent expenses and avoiding fire sale decisions in an already stressful and grief-stricken situation. A fourth reason why life insurance is very important for the ultra wealthy is that question of probate and business buyout. And what we see is, as was mentioned before, because the policies deliver immediate funds for heirs to cover probate legal fees, maybe stamp duties and property transfers, or to buy out non family shareholders without a fire sale, this is a very, very critical instrument, right? Because it does all of that. Now, in Trinidad and Tobago, settling an estate often means hefty legal fees and stamp duty bills. And this is a very, very arduous type of upfront cost because bank accounts could still be frozen. All of that is not the case in terms of liquidity if a life insurance payout exists. And so it allows the family to really plan properly and to continue the lifestyle that they are accustomed to. And if you own a business, the same liquidity also lets your like creditors or your surviving partners or heirs to function because you have cash to pay bills and maybe buy out non-family shareholders in the case of surviving partners so that the company stays intact, right? Instead of selling assets at a discount to raise funds or closing up your business completely. Another reason that the wealthy use life insurance is for key person and golden handcuff plans. We see that businesses take out life insurance policies on their star employees or executives or even founders because the company owns and funds the coverage. The growing cash value can be tapped for retention bonuses that keep top talent from jumping ship or to buy out the executive shares if death or disability arises. Right? Why this matters is that when a company loses a key producer, right? And this is really important because we see it every day. If you're a business person and your key person passes on, it can devastate your profits and it can shake investor confidence as well as creditor confidence, supplier confidence within weeks. So, a well funded policy provides an instant level of liquidity to meet promised bonuses, recruit successors, purchase the departed partner's equity, right? Therefore, protecting the continuity, the valuation, even jobs, right? Without even scrambling for bank loans or outside investors. So, it does protect your business. And that's why the ultra wealthy buy insurance. Now, of course, it's not just about the death benefit, right? Or the cash values that could accrue on a death benefit. We also see the wealthy incorporating insurance as part of their living benefit considerations. So, adding things like critical illness and disability insurances can pay you while you're still alive if a serious diagnosis or accident strikes. Because we see, for example, especially when you're in your prime earning years, a sudden diagnosis or a disabling injury can stop paychecks, right? Completely. While, of course, medical bills keep piling up. So, having living benefit coverage allows you to access these much needed lump sums, turning it into an income stream that can keep your mortgage paid, tuition paid, business overhead costs covered, etc. Now, if we fast forward to retirement and the same policies exist, it also acts as a built in contingency fund for costly health surprises, which could preserve your pension or your drawdowns from investments, etc., or avoid the reduction of your estate that you want to pass on to your children or grandchildren because you have to sell something. So it applies whether you are in your earning years or you're planning to prepare for retirement and you utilize these policies as a hedge against depletion of everything that you've built. Now, I want you to see a real world example. Now, you won't find any press release saying things like Oprah or Jeff Bezos have a life insurance related trust or so on, because these things are typically private. But top estate lawyers confirm that many high net worth individuals like these quietly use life insurance to move wealth silently across generations. So, for example, Walt Disney is said to have structured parts of his estate, including insurance, to protect his legacy and avoid tax chaos. Meanwhile, we see the failure of Princess Estate, where no trust, no will, no life insurance policy was in place, and he left hundreds of millions tied up in court battles for years. And it's a stark contrast, and of course, it's a lesson. So the question is, if billionaires are quietly buying insurance, not because they need to, but because it helps to preserve and transfer wealth efficiently, what's stopping us from doing the same on our level? So I'm going to give you 3 tips, things that you can do right now. Step 1, diagnose your gap, right? Pull your latest policy and ask, does it cover 10 to 15 years of my income plus debt payoff and legacy goals, for example? And if you don't know all of these questions, if you don't know the answers to all of these questions, then it's quite possible that you have a gap. Step 2, you want to stress test your numbers. You want to understand what your numbers mean. And inside my Retire Ready Jumpstart bundle, I do have access to tools that would help you see where you are and literally pull down line by line how much protection your family would need if tomorrow never came. And that is really important. How much protection they would need, how much protection you would need if you were diagnosed, etc. But you want to stress test your plan, and that comes with a bit of guidance, and you do have that available. More information a little later on will be given. In step three, you want to architect your coverage stack. You want to match each risk, right? So you want to know, whether death, disability, critical illness, or medical costs, do I have the relevant policies to match that? And that's where we map out, on your journey with us, your entire plan for retirement. And of course, if you want more information, you can get that information in the description below. So I just want you to be knowledgeable of what is possible. All right. I just want to also encourage you to remember that having a policy is not the equivalent of being fully covered, because wealthy families audit their coverage every year, and you should too. It's really important that you find out where you stand. So, if you're ready to bulletproof your retirement blueprint, why not grab the Retire Ready Jumpstart bundle at retireready.yourgoalsyourplans.com. In that bundle, you'll have access to tools, checklists, step by step videos, and you will also have access to strategic calls, group sessions in what we have as your financial incubators, etc. And if you want to have a deeper dive, in part two of my book, Aligned for Freedom, I unpack the full insurance and immediate reserves framework, along with your entire portfolio framework that you would need to build in your retirement planning process. So remember, it's not about how much you can lose today. It's really about protecting what you've built for tomorrow. So retirement is not an age. It's really a pleasure that I get to do this with you guys, but I want you to know that retirement is not an age. It is a strategy. So let's craft yours on purpose, not by accident. I'm Tennille Alonzo. Thanks for listening to this episode of Retire Smart, the Uninitiated Guide. Until next time, keep planning with purpose and live aligned. See you on the next episode. Bye.